Welcome to the LifeSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and a warm welcome to LifeSquawk's Market Talk weekly review. This is where we try and break down key stories of the week gone and implications for the markets. We'll also take a look at the week ahead and give you a heads up as to what you should be looking out for. It's going to be a packed week next week, so there's quite a lot to get through. I'll be joined by a market expert as usual, and I'm glad to have Sam Cutler of 333 Capital join us on this week's show. He's been one of our regular guests, and he's always very popular when he does come on. So we'll say hello to Sam in a minute. Before we do that, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to say hello to Sam. Hello, Sam.
Hey, Harry.
How you doing, my man?
Yeah, not too bad, man. How about yourself?
Very well. Just to let everyone know, I was in Montreal past week, and I met up with Sam, and we had a nice sort of chat over a coffee, and put the wells right. So we've been talking the markets for a couple of days ago, and it's great to have him on this episode as well. Right. If we'll crack straight on and go over what everyone was waiting for. We've recently just had, I say recently because we're recording this on Friday, the 24th of October, about an hour or so after US CPI data inflation print was released. And it came in a slight softer print. We got 0.3% from 0.4 for the headline number itself. And for the year over year, I think we saw 3% for both the headline and for the core reading. So softer numbers and softer metrics overall within the report. But Sam, what were your initial sort of thoughts on the data?
Yeah, I mean, it was a little cooler than I think most expected. I mean, I had core coming in at around 32 basis points month over month, and it came in surprisingly lower. I mean, unrounded, it was 0.227 and down from the prior month. So pretty benign reading. And I think, that there were a few surprises in there. One of them being that the main driver was service costs, right? Like shelter costs, I should say. That was a pretty meaningful surprise to the downside. Owner's equivalent rent only increased by about 10 bips on the month, and rents were up by about 20 bips. So pretty big deceleration from the prior month. Services also came in pretty low. As expected, I mean, the used cars component fell a lot. That was down 41 basis points.
But that stood out a little bit for me.
Yeah, that did. I mean, that was kind of expected. If you looked at some of the alternative data, it looked like there was pretty much almost going to be no inflation in used cars, but it was still a pretty big substantial drag, like more of a downside surprise. The one thing that did stand out a little bit though was the supercore, right? That did accelerate a little bit to about 35 basis points month over month from that 33. So kind of tells you that, the headline prints was pretty much driven from that deceleration in shelter costs. But overall, very benign print. And I'll say it again, like it's pretty old data now. And I think the market's just going to be much more wrapped up in it because, look, it's the only piece of official data that we've had. And I didn't know if you caught this, but after the CPI report, the White House came out and made a comment that there's probably not going to be an inflation report next month.
Yes, I think Hassett was on the wires and on the sort of news channels afterwards. But yeah, we did catch that there probably won't be one next month, which is a dire state of affairs, as we've talked about previously as well.
Yeah, so I don't think, again, this pretty much just cements, barring the government reopens and somehow they can collect all this data and get it out there in time. I think it pretty much just cements the Fed for a cut in October and a cut in December.
Yep. Yeah, fair enough. We'll come on to the FOMC anyway when we have a look at the week ahead, which we'll do shortly. So we'll circle back on what this all means for the Fed. I just want to. It was an inflation week, really. We had a lot of inflation reads from around the G7, and we had the UK as well report on inflation and retail sales earlier today. Just on the UK, I mean, you see in my notes that I've said. Is strengthening the disinflation narrative, but the activity it has been moribund for the UK. Yes, we saw retail sales keep up the summer trend of fairly decent consumption, really, by the UK households, but ultimately, people are still looking for this to start to ebb away. We've got as we've mentioned again, we've got the budget at the end of November, which is really, I guess, for some people, the key focal point, and will determine really going into year end and beyond where they put the UK economy and its likely path of a monetary policy path moving forward. I know you have a broad spectrum of markets that you look at. Do you have anything on the UK situation at the moment that strikes you?
Yeah, I mean, I think you just take everything kind of on the whole that happened in the past few days with the data releases, but also keep in mind, like, I don't think there's going to be much material till that budget meeting in November. But there were some positive signs in the recent data, right? Like the manufacturing this morning, like that's the first expansion posted in 12 months now. And, on the other side of that, inflation input costs, I think they dropped to like a 12-month low. So that's kind of a positive sign for the Bank of England. And you did see, job losses moderating to the slowest pace since May. I still think, they have some policy catch up to do. I definitely think there's going to be at least, one cut into the year end. And then I the first half of next year, I think is a little underpriced for how much is being cut in there. Like if you look at, kind of just the SONIA curve, if you look at kind of that December to like M6 part of the curve, we got some pretty decent flattening in that recently from, 20 bips to about 31 bips, right? And I think that could continue to widen further as, inflation looks to maybe not be so much of a problem anymore. The economy there is slowing, GDP is a little sluggish over there. I think they could get more comfortable cutting into.
You're being too kind, a little sluggish.
I think they could start, pricing in some more cuts into the first half of next year. So I'm kind of looking at that, part of the curve to just continue flattening out some more.
Okay, well, just to give you this is perspective from one of the analysts that write in Validus Risk Management's Pierre Roque. An analyst there says this morning's UK data paints a picture of two economies. Retail sales surprise to the upside, signalling that consumers remain resilient for now, but the latest PMI reading sends us a more cautionary message about what lies ahead. As a forward-looking measure of business activity and confidence, the PMI suggests momentum is fading, with overall growth sliding since August peak of 53.5 to 51.1. That divergence underscores a widening gap between consumer and business sentiment. Households are still spending, providing a tailwind to inflation that remains nearly twice the Bank of England's 2% target. Meanwhile, businesses are losing confidence amid weaker global demand, political uncertainty, and tighter credit conditions. Manufacturing was a drag on the readings that we did see today, and puts it into contraction territory at 49.6. Services coming at 51.1, as we said. And we know the Bank of England looks at some of these forward-looking survey data. Saying all that, we're not expected to see the bank move at its November meeting. And as Sam says, we have to look further afield, I think, for any signs of that. And probably after the November or autumn budget, will we really start to see both investors take and monetary policy as well on where we're going for the economy. So that was that. I just want to move on to Japan now. We're skipping all over the world because it's been in the headlines quite a lot lately for political as well as monetary policy reasons. We saw Japan's CPI for September out, and it left December on the cards. Now, I mean, many were looking for October as a move, as a hype for the Bank of Japan Policy Board, but that's now been moved out to December. And then we also had Japan's Prime Minister Takaichi vow to boost defence spending, amongst other measures she's looking to bring in. It's still early days for her as the Prime Minister, and she really has to sort a few things out that need sorting for the country. But any views on maybe the yen or just your general views on where Japan's going?
Yeah, so I mean, I think a lot of her win was kind of priced into the markets, right? And I think we have about 12 basis points of hikes priced into the curve into the year end. Now, this has shifted around a little bit, and it started to drop when she won the election there. But she made a comment about maintaining the BOJ's kind of independence, and that is when you kind of start to see a little bit of repricing in that. So I'm still of the opinion there's at least one hike on the table into the year end. More likely than not, that comes in December. And I mean, the yen, man, this has been a trade for me that has just sucked. I haven't been outright long the yen, but I've been a big believer for a long time that currency vols are just so underpriced. And with, all these, kind of central bank divergences that are happening, and, the Fed looking to cut even more now. Well, Europe's maybe done their cutting cycle, which I don't think is the case. Then you have, the UK here maybe starting to look at cutting more into the first half of next year. I think vol here is just so underpriced, and I've been saying this for I think 4 or 5 months now. I've had positions in long dated yen options on a vol basis, and I mean those things are just they're just bleeding out over time. But I do think there's some really interesting trades in Japanese yen, even in sterling. From a vol front, I think vol is very underpriced in the currency space, and I think that could come as a shock to markets.
Interesting. Okay, there's one to watch on that front. I want to look at the week ahead because, again, we're lurching from week to week in terms of the US and what traders want to pin their trading week on. And next week is a bit of a humdinger generally for central bank decisions. We have from the major central banks, we have the US, we have Bank of Canada, we have ECB, all up next week to announce policy. We'll start with the biggest, the FOMC rate decision. We saw after today's CPI reading, I'm showing a chart there, a spike in the S&P, leading to probably heightened expectations around a rate cut next week. It was pretty much nailed on anyway, wasn't it, Sam, as we've discussed. So in terms of what we look for from next week, I don't like to play down an event, but it's kind of like as you were. And for the next 2 meetings, I think there's very little danger that they won't cut, data aside, and we haven't got any data to put aside. We're in a holding pattern, we're in a pattern at the moment, a cutting pattern, shall we say?
Yeah, and I think I think every the cuts are priced in, right? I think 2 cuts now is a done deal for the year, right? We're not going to get any employment data, it looks like. So take 50 bits off the table at any meeting, right? I think in order to put 50 bits on the table, you would need employment data to come out, and you'd need a decent spike in the unemployment rate, right? I think the Fed had it projected to be 4.4, 4.5 by the year end. Right. So I think you need to achieve that or something even more to put 50 bits on the table. So I think that's just out of the question. So I think we're looking at, 25 in October, 25 in December. But where I think the markets are going to be looking at, because this is kind of well priced in, right? I think they're going to be looking at the QT comments, right? Because there was a big shift in expectations. I think most expected QT to end, maybe at the very earliest in December of this year. But I think the most probable scenario before a few things that happened was, probably January or within the first quarter of 26. But
let me just quick QT for those unaware is quantitative tightening. Like we had quantitative easing when the liquidity, the system was flooded with money. Quantitative tightening is almost is sucking that liquidity out the system. And was it last week? I mean, it seems like long ago now when we started seeing some of those regional bank worries there. This is what's prompted this discussion about QT and where we're going with it. So just to put that into context for our listeners. Sorry, carry on.
Yeah, and I mean, just to put more perspective on that, it's like it's the Fed shrinking its balance sheet, right? And I think at the peak, it was nearly their balance sheet was nearly like 9 trillion, right? And they've shrunk to its current level of about, I think, right a little above 6.5 trillion. And they do this by, allowing a set amount of treasuries and MBS, mortgage-backed securities, to kind of mature without reinvesting those proceeds, right? So, like you said, it's kind of takes liquidity out of the system.
Takes it out of the system.
But what we've seen, which I think has kind of caught them off guard, is some plumbing issues in the market, right? It's been a long time since the effective Fed funds rate has really moved from any of the bounds, right? And we had, the target rate right now is what, 4 to 4.25. And the effective rate was sitting right around 4.09. That's risen like 3 bips to about 4.11. And that's caused a little bit of plumbing stress in the markets. Now it's nothing like 2018, 2019, like the repo crisis, right? There's no major red flags, but it's something to be aware of that is potential stress in the system. And the reason it kind of works like this is if you look at, certain rate metrics, like if you take the SOFR spread, right? The SOFR to interest on reserve balances, right? That's kind of a proxy for how much cash is available to fund the system, right? So when you have bank reserves that are ample, so SOFR is going to trade at a rate below Fed funds, right? So that just kind of gives you more cash to fund the system. Then if you look at an alternative spread, if you look at, SOFR minus interest on reserve balances, right? That's kind of viewed as bank reserves as a percentage of GDP. So when those slip to insufficient levels, you look at it like funding becomes a little more scarce, and both interest on reserve balances and SOFR rates trade higher than Fed funds, and that's kind of the exact recipe that caused the repo crisis in 2019. So I think there's been a few spikes in those that have come kind of above that bound, right? Like you usually see spikes in this at quarter end, month end for some funding stuff, right? But the zero bound is kind of the area of stress, right? You have Fed funds over interest on reserve balances right now trading at around negative 0.4. Kind of spiked up from, they were sitting right around negative 0.7, but the bigger spikes have been, the spread between SOFR and interest on reserve balances. I mean, those spiked as high as 15 basis points in the middle of this month. So it wasn't even around month end. They've since receded a little bit to around 0.06. But I think this caught some off guard that, okay, there is some constraints in the system and there could be some liquidity issues. So I think that's what's kind of prompted the push forward in this potential end to QT, right? And that does have some market implications. I mean, you look at, I think there was some comments out from JP Morgan and Bank of America, who I think they had previously thought, December or early 26, like most people did. They actually now expect to halt the program, that the Fed's going to halt QT this month in October.
That's exactly what I've got in front of me from the Bank of America. At the October FOMC, Fed should cut by 24 basis points and signal QT to soon end. Power to give limited December guidance. They said Fed QT should either be stopped at the end of October or signaled for end of December. We see even possibilities of either outcome. So that's from the Bank of America analysts out there as well. So they're looking for a cue that will give them a signal that is coming to them before year end, basically.
Yeah,
which
And I
allows it to.
think that an early end to QT, I think, would be quite pivotal for markets because, it's like we just said, halting the balance sheet runoff is essentially injecting more liquidity into the financial system, right? So that would be very, very supportive of risk assets, right? So
Yeah.
I hate to say it, but I mean, I think you'd see equities. Well, what reason do equities not have to rally anymore? They rally every day pretty much, but it would be just another,
They don't need much of an excuse, do they? Let's be honest.
exactly.
They don't need much of an excuse.
Yeah, all they need is a 30 bits move lower, and it's a generational buying opportunity here. But
that's seen as a clear out nowadays, isn't it?
Yeah, in all seriousness, I think an early end to QT or an indication of that would really be a tailwind for risk assets.
Yeah, fair enough. Okay, we've got GDP out as well. I think we're looking for, was it 3 point? Someone looking for about, it was 3.8 prior. I think the consensus is about 3%. For real GDP. So flash estimates, the first look at Q3 numbers. So we're looking in the rearview mirror a little bit here, but nonetheless, it's going to be important if it comes out that we get some sort of guide as to the state of the US economy. But again, the problem we've got with all these this data set is reliability, and unless we see the government open up, then the likelihood is this won't be released, and we won't get it, and we won't see. I mean, I'm presuming most of the data has been collected now for Q3 period, anyway, from the is it the Census Bureau that brings that does the GDP? I think it is.
But again, the data might be partially collected, fully collected, but then they still have to compile the data.
True.
Right. So true. I'm really unsure if we're going to get any meaningful updates on that.
Yeah, and also, the only reason I sort of listed it is because of what we saw with CPI today, and I know there was a regulatory reasoning behind having to release CPI in order to pay benefits and so forth, and to have a measure to put against what you pay in benefits. So there was a reason why CPI was out, and because it had already, for the most part, been collected and collated, there wasn't too much to it to put out. Obviously, like you say, with Q3, it's slightly different beast, even if it is covering the months gone. So I put it in there because it was a part of the talking point, and I think there was a story last week about the Fed and ADP data. They used to get ADP reports from the private payrolls company that they use within their calculations, and that was stopped in recent weeks as well. I don't know if you saw that from the Wall Street Journal broke that.
Yeah, I saw. I did. There was some kind of financial firm that ended up getting like exclusive rights to it.
That would be the first time. Well, I know that it's been mentioned numerous times by Fed officials. Powell's mentioned it. I think the Waller mentioned it. It was after Waller, I think, referenced it in a speech recently that it wasn't being given to the Fed anymore. But that's an ongoing story and a bit of an aside anyway. But okay, so we get 25 basis points next week. We know that. We'd like to see another 25, and it's the QT story we're looking for from the Fed. Bank of Canada, we had inflation data out this week. They're going to announce interest rates next week as well. Where are we at with that? I mean, I think the markets are pretty much convinced that a cut needs to happen. So there's a analyst now look for a consensus 25 basis point cut. But I mean, there are still some that look for rates to remain on hold this month. And as I said, we had CPI out this week as well. What are your views on the Bank of Canada and what we're likely to see from them?
Yeah, I think for sure they're going to cut at this upcoming meeting. Right? I mean, the Bank of Canada is definitely set up to cut 25 bips at this next meeting. I think current pricing's around 21 basis points, so that would be about an 85% chance of a cut. Even though we did have a little bit of firmer inflation on this last print, it's the employment and the GDP picture out of Canada is still very sluggish, right? So we have inflation pretty much within the central bank's bounds for their target ranges, right? And we have unemployment continuing to tick higher. Yes, the last employment report.
I was going to say the last one, but sort of it kind of made up for some poor readings of late.
Yeah, it was a little bit better. I was trying to just look at what the exact numbers were here in Canadian employment, because a large gain this month came from the full-time metric. So that was probably some seasonality adjustments in that. I mean, if you look at the last print, right? I think we printed negative 60, negative like 65,000 or something at the end of August, and we did rebound.
We lost 65,500 at the end of August, yeah.
And we rebounded pretty significantly to a positive, 60,000 job gain. 106,000 of those were from full-time employment, and the part-time employment metric did drop by about 45,000. So it's still a pretty volatile series here because of the seasonality adjustments that encompass this. But I don't know, man, the trend is still materially lower here. I don't think inflation is going to be a huge driver for any concerns here. I think it's more, does the Bank of Canada need to get their rates to where it's most stimulative for the economy, right? And there were some things with the trade war that kind of mitigated some risks, right? And one of those being Canada had dropped their retaliatory tariffs, right? Which kind of eased certain price pressures and, took some pressure off the consumer. But we just had Trump saying that, he's taking off the trade negotiations off the table with Canada now, right? So I think that encompasses, a new risk as well, and that could hurt the, economy here even more. And I think that is the ability to where the market has a little bit more of a chance to lean towards another cut even in December. That's an important thing just to touch on too, right? Because you look at the past, let's say 2 weeks, right? Or look at all of October this month so far. The trade war was kind of in back of everyone's minds, right? No one was really paying attention to this anymore, and it took just Trump to be upset and make a little comment, and it sent the market, almost 3.5% down in one day. So I think there was a lot of complacency around this. And if you look at the equity markets kind of rebound off this now, yes, there's a byproduct of, skew steepening and, hedge risk coming in and, implied vols collapsing, leading to, kind of material, flows to support the market. But I think there's still a big risk here that people are discounting, that the November 1st, nothing really is going to materialize, and there's going to be maybe some tariffs that kick in with China that have some effects. And I don't think this trade war is over yet. And I think there's going to be some surprise headlines that can continue to catch the market off guards. And I think that complicates the picture into year end, because I think everyone's thinking, okay, we're going to get, a nice rally into the end of the year, our typical thing, fiscal flows are set to be strong in the first half of next year. That's going to drive equity returns. But I see a lot of, we're going to go back to just headline risk, right? I think there's still a lot of headline risk in the market on this. And it's just, people are going to be caught off guard. And it's one of those things where you have, forced buying from funds, right? So you have, the vol control funds that have deleveraged a little bit because we had those spikes up in realized vol, but that's already starting to collapse back down, and they've been net buyers over the past 2 days. You have the CTA thresholds to where CTAs would be net seller of equities. I think that's down. If you look at the ES, I think that's right around 65.40 is their trigger to sell, which is pretty much almost right where we traded to. They've been net buyers here. Retail inflows have been very, very strong. So it's like there's all this forced buying out there because we have, low levels of volatility. So I still believe that there is, the risk out there for some kind of headline, some kind of most likely coming from, Trump and China, that cause another, substantial spike in volatility, which leads to these, quick, rapid sell-offs. Now, it seems to me like the mentality is really buy the dip on these. So I don't think that's going to materially change. But, you can get hurt when stuff like that happens, especially with, all the pod shops now and the dispersion trades and all these, factor trades. There's a lot of messy things out there that are creating
that skew basically not necessarily direction, but the level of volatility within a particular.
And that's what I'm trying to say. Like, I understand all the buying that's happening, but then you also see this. Like, okay, like we had that Trump headline. The market sold off 3%. We're hitting new all-time highs today. What has materially changed that gives us confidence that everything is good?
Yeah. Oh, well.
Yes, cool. The Fed's cutting rates, but that's been baked into the market.
Priced in.
Like the 1 year, which I think is like my favorite proxy for like the terminal rate, right? The 1 year rate's at 295, right? So that's still implying like in the next year, we're getting, roughly 116 bips of rate cuts. So like that's priced into the market. So if the 1 year is going to move lower, that's going to have to come from, economic deterioration, I think.
Sure.
And if that's going to come from economic deterioration, it's such a skew of us trading at all-time highs with, all these underlying risks. But it's just priced to a perfect scenario where everything falls into place. And I think in markets, nothing ever really falls into perfect place.
No, I mean, it was only a week and a half ago when we were saying, oh my God, that this is it, taking cash and keeping cash on the sidelines at the moment, this, that, and the other, and next thing you know, we're up again. So, right, I want to move on. We got the ECB interest rate decision. We're looking for no change there. A couple of comments there from ECB board members. Joachim Nagel of the Bundesbank, they're not ones to be on the dovish side, noted that inflation appeared sticky, but viewed the current interest rate trajectory as clear, signalling in favour of holding rates steady unless new information were to emerge. He also pointed out that global tariff tensions have created a lose-lose scenario for global growth, even as Germany's robust economic performance offers reassurance. So going back to it all comes back to tariffs and trade. We had Martin Kocher. I've said it about 3 different ways every time I've announced him. And he expressed that ECB's rate cutting cycle is likely ending or already over. I think it's a bit premature. Advocating for a meeting-by-meeting decision process rather than committing to a fixed policy path. He also emphasised that inflation expectations will remain well anchored and saw no compelling case to increase interest rates, while acknowledging downside risks warrants ongoing vigilance. So we got Eurozone GDP also out this week as well, which should be of interest. Again, another prelim print there. We're looking for a flash expectation. Where do I have my consensus here? Of 0.1%, I think quarter on quarter, 1.2% year over year. Again, quite tepid performance there from the Eurozone as a whole. But we're looking for that to maybe be boosted next year with all this defence spending and coming in from around the bloc. And then Australian CPI for September's due for release as well. We have a number of other interest rate announcements from some from other central banks as well to contend with. So it's a busy week. So good stuff. Listen, Sam, I'd like to thank you very much for your participation today, and it was good to see you in the flesh as well last week.
Yeah, anytime, Harry. It's always good, and it was a pleasure to meet you too. It was a nice time.
Yeah, likewise. Okay, if you've missed the start of today's episode, you can listen back on X or YouTube, or find us on the podcast platforms such as Spotify, Amazon Music, or Apple Music, as well as other places. Thank you again for listening, and have a great weekend. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.